Hi there, in this video, we'll explain how Section 24 works in 2026, using real numbers to show how the 20% tax credit affects landlords.
Some UK landlords with mortgaged properties are now operating at effective tax rates of 54% on their actual cash profit. In some cases, the tax liability wipes out their real earnings entirely. I am a tax advisor at My Tax Accountant, or MTA, where we specialize in navigating complex HMRC legislation for UK property owners. Today, we are looking at Section 24 mortgage interest relief in the 2026-27 tax year, and we are going to work through the real numbers. Section 24 creates a structural disconnect between a landlord's tax bill and their economic reality. It forces you to pay income tax on rental revenue that you never actually keep, money that goes straight to the bank to service your mortgage. For the 2026-27 tax year, this mechanism collides with a second issue, the freezing of income tax thresholds until 2031, creating a silent, compounding fiscal drag on rental yields. Relying on rough estimates to gauge your tax exposure is no longer a viable strategy. Calculating the exact math behind Section 24 is the only way to protect your portfolio's yield from being decimated. Our baseline case study: a property generating £50,000 in gross rental income, with £5,000 in operating expenses and £30,000 in mortgage interest. Under pre-2017 rules, both expenses and mortgage interest were fully deductible from the gross rent, leaving a true taxable profit of £15,000. The 2026-27 Section 24 rules completely rewrite that calculation. While the £5,000 in operating expenses is still deductible, the £30,000 in mortgage interest is now blocked. The result is an artificially inflated taxable profit figure of £45,000. Under the new rules, this £45,000 is phantom profit. The system requires landlords to pay income tax on money they never see, breaking the link between tax liability and wealth creation. Applying the 40% higher rate tax to that £45,000 phantom profit gives an initial tax calculation of £18,000. That is HMRC's starting baseline. To compensate, Section 24 provides a 20% credit applied strictly to the £30,000 of mortgage interest. We take the £6,000 tax credit and subtract it directly from the initial £18,000 tax bill. This leaves a final net tax due to HMRC of £12,000. Now we step away from the tax return and look at the real-world cash this property generated before tax, which was £15,000. By contrasting the £12,000 tax bill against the £15,000 in actual cash profit, we see that HMRC is claiming 80% of the property's net economic return. The landlord is left with a post-tax cash position of exactly £3,000. Compared to the pre-2017 rules where the tax bill would have been £6,000, Section 24 causes a massive tax surge. This causes a 100% relative tax increase on the exact same asset, eroding the net yield even when the property performs perfectly on paper. There is a persistent misconception that this math only impacts high earners or those already in the higher rate bracket. Take a landlord with a standard employment salary of £35,000, plus a single property generating £16,000 in gross rent. HMRC assesses total taxable income based on the gross rental figure before the mortgage is paid. Adding the £16,000 gross rent to the £35,000 salary hits £51,000, breaching the frozen 2026-2027 higher rate threshold of $50,270. This structural trap is known as band creep. Crossing that line exposes part of that income to a 40% tax rate, while the mortgage interest relief remains locked at 20%. It also risks triggering secondary penalties, like the high-income child benefit charge. Section 24 secretly converts genuine basic rate taxpayers into higher rate taxpayers. It forces them to absorb massive new tax liabilities without generating a single extra penny of actual spendable income. Navigating this math requires immediate changes to how you maintain your records. In April 2026, HMRC rolls out the first phase of Making Tax Digital for Income Tax, or MTD-ITSA. This mandate applies directly to individuals with qualifying property or self-employment income exceeding £50,000. For those caught by the threshold, the traditional annual tax return is replaced by a strict requirement to submit quarterly digital updates using approved accounting software. The software requires you to digitally separate your carried forward finance costs from your ordinary property losses. If you lump these two distinct figures together, the software will fail to calculate your 20% Section 24 tax credit accurately. In the MTD era, poor bookkeeping carries a heavier cost than standard compliance fines. It directly jeopardizes your legal right to claim your mortgage interest relief. Securing your current position is only the first step. You must also prepare for the near horizon, April 2027. This timeline illustrates the impending change. Property tax rates will rise by 2% across all brackets, to 22, 42, and 47%. While the basic rate credit also rises to 22%, the increased rate applied to your phantom profit ensures a net tax increase. To mitigate this, one structural option is transferring property ownership to a basic rate spouse, fully utilizing their lower tax bands before they are breached. Another method involves aggressive pension contributions. This artificially reduces your adjusted net income, pulling you back under the higher rate threshold and reversing the effects of band creep. Operating through a limited company is one structural alternative, as corporate entities retain the ability to deduct mortgage interest as a business expense. However, transferring properties into a company triggers stamp duty and capital gains tax implications that must be meticulously modeled first. Passive property ownership is a mathematical liability under these new rules. Active structural planning is required to survive the 2027 rate hikes. Section 24 taxes phantom cash, pushes you into higher brackets, and demands strict digital compliance. To map out your exact exposure and explore corporate incorporation modeling, contact the team at My Tax Accountant. Our details are on screen. Make sure to subscribe to our YouTube channel for ongoing technical breakdowns of UK tax legislation. Please note that this video is for educational purposes only and does not constitute financial, legal, or tax advice. Personal tax positions vary greatly based on total income and ownership structure. Always consult a qualified accountant before making structural changes to your property portfolio.